G'day everyone, welcome to the weekend general update for the 18th and 19th of May. Another very strong week for markets around the world, but certainly much less so for our market. So we're at a pretty pivotal point at the moment where I think we could be approaching a bit more of a correction in the US, and our market is already suffering from what looks like an outflow of overseas money as the Australian dollar falls. And the Aussie dollar certainly did fall sharply on the week and finished down around 97 cents. So let's have a quick look at the summary for the week. The S&P index jumped another 34 points on the week after around 20 points the previous week. And the deviation to the 150-day moving average is really getting to quite an extreme level. Because there is no overhead resistance, we've never been at this level before, there is no reason why the market can't keep going up, except for the fact that markets always revert to the mean at some point, and we really are reaching an extreme level of deviation from the mean at the moment. So that's why I think in the next few weeks, possibly even the next few days, we may see the US market just start to take a bit of a breather and get rid of some of that excess. Now our market by comparison was really disappointing, fell 26 points on the week. So it was one of the few stock markets around the world to fall. And to me, the only rational explanation is that there's quite a lot of overseas money that had come in here for all sorts of reasons, for the dollar, the high yields on banks and Telstra, the massive oil and gas projects around Australia, for all those sort of reasons, safe haven status. And I believe that now people are getting more and more comfortable with overseas markets. They're getting more and more comfortable with taking higher levels of risk, and so they no longer see it necessary to basically sit in more of a safe haven destination. The fact that the Australian dollar is falling means that they're losing money on the currency impact, and so that money is now flowing out of Australia and going back to America or Europe, where people are prepared to take more risk in the market. Now gold, big loser on the week, down $90, and it's really quite amazing the punishment that gold has taken. I believe there's a lot of things in place that we're close to a low in gold and gold stocks, but until we actually see confirmation of that, you certainly wouldn't want to move on it. Copper holding $3.30. Oil was steady at $96. So there's the 6-month copper chart. So you can see we seem to have formed a double bottom down there just above $3. Stabilized and starting to head back up again. So let's have a look now at some charts. So we'll start with the S&P 500. You can see we've been in a really clear channel, and we've actually broken above that channel. The red line is 150-day moving average, and you can see just how far above that level the price has now become. It really is at quite an extreme to the upside, and it's for that reason that I think it's inevitable that we'll get a correction. We just don't know exactly where from. The RSI quite overbought now, so this would certainly be an area where a quick 50-60 points to come out of the market would not only be pretty normal, but would also be very helpful, because it's starting to get a bit dangerous to trade at these sort of levels given the overhang of this correction. But look, it's across the board in the US. It's not just the major stocks. If we have a look at the NASDAQ, there's the NASDAQ index, enormously strong, in fact really starting to accelerate to the upside. We also look at the Russell 2000. This is the small and mid cap index. It's also powering away to new highs. If you remember, about 3 or 4 weeks ago, I was concerned that the Russell 2000 looked like it was running out of gas and we were getting some divergence. The broader market was weakening, but that's just been absolutely blown away in the last 2 weeks. So extremely positive in the US. and I really think that's going to continue for probably another year. However, you need to be getting in after corrections, not when they're highly likely to occur. Just as a bit of an aside, the Chinese market, this is the Shanghai Composite Index, had a bit of a pullback. It's formed a double bottom and now has formed a higher high and a higher low. So it looks like the Shanghai Index is back into uptrend. And if we have a look at the Japanese market, this is just phenomenal what's happened in the Japanese market since they announced their money printing. You can see we were down 8,500 points, now we're up at 15,000 points. The Japanese main index is not far off doubled, and that has occurred basically since the 16th of November. So that's a weekly chart, so that's been an absolutely meteoric rise. Now the other strange thing that's going on at the moment, normally when the US dollar is rising, it means people are going into the US dollar as a safe haven, and that means money's coming out of stocks. But at the moment, we've got the US dollar rising and we've got stocks rising. So there's some very weird stuff going on at the moment, which makes it trickier to know what's going on in the market in the very short term. I think the long-term trends are pretty clear, but in the short term, we're at extremes in several markets, extremes that don't really make sense. And so I think in those circumstances, you're best to just step back a little bit and wait until we get a bit of a corrective phase. Looking at the Australian market, this is the Aussie index. As you can see, the US market is up very, very strongly in the last 2 to 3 weeks. The Aussie market is, we went up initially, but we've really been flat for 2 weeks. So that's pretty disappointing. Let's have a look at it from a sector point of view. Here's the main sectors. So you can see on the top, healthcare still sprinting ahead by clearly the strongest Australian sector. We've got telecoms and finance, the next two, the blue and the green. Very similar, but healthcare is really still forging ahead. And then way down the bottom, we've got energy, the small cap index, and bringing up the rear, we've got the materials sector. You can see both materials and energy started to turn around. They've just kicked up a little bit in the last few weeks. So we are seeing a bit of a sector rotation from banks and telecoms. You can see they've been flat, whereas materials and energy have really kicked up a little bit. So there's definitely money starting to flow back into the resource side of it, but I think this overseas money influence on the larger stocks is certainly going to have an impact. And finally, let's just have a look at poor old gold. This is gold on a daily basis. You can see it was a pretty rough week, and if we look at this on a weekly chart, we're heading back down to these 1320 lows. Looks like we're going to retest the lows. We could even go below it. Let's just pan back and have a look. So this is the retracement structure that I've had on here now for probably 6 months or more. We had support levels or potential support levels at 1448, which was obviously broken. Then 1302, we didn't quite get to there before the bounce, so we may actually go down and try and find that level. If that breaks, then we're looking at around about 1160 for gold. So 1160 is possible. Now if gold does get down to that level, I can tell you that gold stocks will be an absolute screaming buy down at those sort of levels. And of course the most important chart that we've got to look at is the spread between the GDX, which is this one. You can see this GDX, which is the gold miners index in the States, still continues to fall through support level after support level. It's just quite extraordinary, and we've broken another one. So it's possible we could still have one final last really smashing of gold stocks. You can see clearly the red line's is the 50-day moving average, and the purple line is the 150-day, and that's well and truly rolled over. So gold stocks still in strong decline. but the most important chart to my mind is this the spread between the GDX and the US dollar gold price, one divided by the other. We need this to turn around. We need to see it back above this red line before we would consider going back into gold stocks, and clearly there's no sign of that at the moment. So that's the primary signal we're looking for on gold stocks. So that's it for this week. It's going to be another good week. Just from a strategic point of view, I am back into caution mode on overall exposure. So with the US market having risen 85 points in 3 weeks, expect to see some sort of pullback in the US, because otherwise we're just not getting high probability entries on the trades. The sentiment for gold stocks is at 2008 extreme low levels now. However, wait for the turn. Don't try and anticipate it. It's just too dangerous at the moment. So that's it for this week. Looks like we're going to have a pretty strong start to the week, and certainly things still looking pretty good for the small cap non-resource stocks. They've been absolutely fantastic this year, and they still look as though they've got some good upside yet. So that's it. Cheers.